All right. So let's proceed to the pre-populated spreadsheet. All right. Let's see who is here now. Okay. Right. So first we need to know what was goodwill, how much was goodwill rather. Right. Okay, how do we calculate goodwill? We need to know the calculations, basic knowledge that you need to carry forward. We have consideration. How much a consideration they are saying here? The exhibit, they gave the consideration 35 million. Okay, 35 million. So let's do work in millions. All right. Then the NCI acquisition. How much is the NCI acquisition? NCI was measured at fair value of 51 million. NCI 51 million. Right. And then fair value of net assets at acquisition. How much was that? Fair value of identifiable net assets was 83 million. Fair value of net assets 83 million. So that will be deducting. And we arrive at goodwill. Right? So goodwill is 3 million. Right? Goodwill is 3 million. So they've recorded a goodwill of 3 million. Let's make all the adjustments. Or let's make the adjustments as we proceed. Right? That would be easier. Right? So first we have to remove the subsidiary here. Remove subsidiary. Right. So goodwill of 3 million, we remove that first. We've identified how much is the goodwill. So we remove the goodwill of 3 million. Okay. Right. Now let's go back to our working. Then we have the fair value uplift, fair value adjustment. If you read further, we can see the difference between fair value of net assets and the carrying amount in the individual financial statement is attributable to property, plant and equipment with a remaining useful life of 5 years at the acquisition date. Right. Working to PPE, fair value adjustment. Right. What was the PPE figure? What was the PPE figure as per statement of financial position, individual financial statement? 32. Right? As per SFP was 32. Okay? And then, what is the uplift? How do we know the uplift? Uplift is going to be the difference between the net identifiable net asset, which is 83 million, minus the other components of equity. Right? So net assets. We do another working here. Still working 3. Net assets. Okay. Share capital remains the same in the individual financial statement. There is no adjustment there. Since they've done subsidiary adjustment, share capital will be remaining the same. 10. Then other components of equity also will remain the same. 3. There's no changes there. Only change we'll see will be in retained earnings. So we have to get the retained earnings pre-acquisition. Right? How much was that? They've given it here. On 1st January, Braziliaco had retained earnings of 39 million. 39, right? And then identifiable net assets total. Identifiable net asset is 83. So we know that the difference is going to be the fair value uplift. How much is total here? This plus this plus this. So fair value adjustment going to be 83 minus 52. So that's 31 million. So fair value adjustment is 31 million. Now when there is a fair value adjustment, there will be excess depreciation as well. How much is going to be the excess depreciation? Fair value, excess fair value meaning fair value adjustment divided by useful life remaining, which is 5 years. That's what they're saying here. Remaining useful life of 5 years. So 31 divided by 5 is our excess depreciation. Okay, that's the excess depreciation. So property, plant, and equipment total would be how much? Plus this minus excess depreciation. So we'll make it minus 6.2. That's 56.8. Now we have to eliminate this 56.8 from our subsidiary. From here we minus 56.8. Be very careful with plus and minuses. Investment in associates, we will be adding the investment. What's the investment in associates? That is a part of subsidiary removal. When you remove subsidiary, the investment, the consideration paid will be already the investment in associates. That is 35 million, which is given here. The 35 million that we take it at the face value there. Current assets, this includes the current assets of the subsidiary. Current is 47, so we deduct the 47 million as well, right? So there we remove by deducting 47 million. And then we also would have the retained earnings, right? Retained earnings. Now we do the next working for retained earnings calculation. Okay, right. So retained earning at reporting date, how much was retained earning at reporting date? Consolidated retained earning at reporting date. Retained earning at reporting date was right. So retained earning they've given here is 55. Okay, at reporting date was 55. Post acquisition retained earnings. Okay, let's go back. So retained earning at acquisition was retained earning at acquisition was 39 million. Okay, that was the retained earning at acquisition. Right. So retained earnings at acquisition, when we look at that, always remember, now although we did not do a complete working at the pre-acquisition stage, we know at acquisition and post-acquisition, the 55 retained earnings that is given here, 55 retained earnings which is given here, there would have been the excess depreciation adjustment, right? What happens? The identifiable asset, what do? We have the retained earnings, right? The closing retained earnings is where the excess depreciation should have been done, right? Expense. So that brings your retained earnings down. So retained earnings at acquisition is what we have, and retained earning at reporting date. Reporting date will be 55. We know it was there, minus we deduct the excess depreciation, and our retained earning at reporting date is 48.8 million. Okay, so what is the post acquisition? Post acquisition is 9.8. Now 9.8 is not parents alone. What is parent? Now we have to split it among parent and NCI. Parent was 45%, NCI was 55%. Okay, so this into this is our parents' retained earnings, attributed parents, and this into is subsidiary, NCIs. Okay, that is NCI's retained earnings. Now we will have to remove the retained earnings also from removing the subsidiaries. Right? When we remove subsidiary, we'll be removing the retained earning as well. 4 point. Okay, the parent component only, and the current liabilities. Let's go back to the individual financial statements. There's a current liability of 11, so we remove that also. Right, that 11 is also removed here. Clear? So that also we remove. And then the next item that we have done, which we have to remove, is going to be working 4. We've done working 3, so working 4, which is NCI. At acquisition, how much was the NCI? At acquisition, NCI was 51. Retained earning attributable to NCI, post acquisition retained earning, post acquisition 5.39. So NCI at reporting date equals this plus 56.39 that we remove from non-controlling interest. And with that, we have eliminated the NCI completely. Subsidiary has been eliminated now. Okay, subsidiary elimination done. Then we have to make another adjustment, which is going to be associate profit. Now this is associate profits. Retained earnings removed as subsidized profit will be associate profits. So we have to consider that 4.4 million as associate profits, which will be added in a retained earning component, as well as investment in associate will be the investment, the initial investment plus the post acquisition profits of the associate. 0.4. Right, 4.4. Clear? So here we have adjusted associate profit as well. This is done. Exhibit 1 done. Exhibit 3 done. Right, now we are moving to exhibit 2. Exhibit 2, we have already done that working here. We've already done the working of exhibit 2 here. So we exactly know what is going to be the deficit. Deficit is going to be 40 million. We know that, right? Deficit is going to be 40 million. Okay. So pension or defined benefit. obligation. Right, defined benefit obligation is going to be net defined benefit deficit is going to be 40 million. That we know. We know it's 40 million. But how the adjustment would happen, that also we know, right? We know what the adjustments are. So adjustments are going to be on other components of equity as well as retained earning. Other component of equity, how much? 2.8 remeasurement component, right? 2.8 of remeasurement component. Cost, net deficit we're adding there, so it's a cost. So we deduct, right? Debit the other components of equity, right? Because we are recording it through other comprehensive income. Okay. Then retained earning adjustments. The service cost, the interest cost will be deducted. It's a cost on your SPL. It's an expense. So you deduct that from your retained earnings. And your contributions, which they have expense, you have to add that back also. Right? So what are the figures? We had minus 16 plus we had minus 1.2 plus 4. Okay. So retained earnings. We'll do a separate working here. So that's clear. That makes things clearer. Working 5. Define benefit obligation. Right? Opening net deficit was 24 million. Interest expense was 1.2 million, which was this into 5%. Then the service cost, just bringing the what we wrote into table here, was 10 plus 6, which is 16. Then cash contribution was minus 4. Net deficit as at 31st December X7 actuarial calculation was 40. So we know the remeasurement component was added to net deficit of 2.8. That's what made it 40. Okay. Now this is going to deduct our retained earnings, and plus our retained earnings. Okay. This is going to credit the retained earnings, debit the retained earnings, debit, credit, right? And then this is going to debit our OCI. Okay. Now we know the retained earnings figure that we'll be taking is minus 13.2. Minus 13.2. Okay. Minus 13.2. Right. So here they've already given net defined benefit deficit 24. So it becomes 40 at the end. So we know the difference will be 40 minus 24. That's 16. Okay. So that's in one line. Or if you want, you can even break it down. How do you break it down? You can show your pension interest separately. Then you can show pension service cost separately. Then you can show pension contribution separately, then you can show remeasurement component separately. You can show it separately. How do you show it separately? Pension interest, you are going to adjust the retained earnings by 1.2 minus 1.2. Then you are going to adjust the net defined benefit deficit by adding 1.2 there. So I'm just showing how we do it separately also. So let me just take these off. Okay, so this is the second way that I'm showing to you. Pension service costs, retained earnings, you deduct from retained earnings, and then you add here obligation or liability. Then contribution, cash contribution, they have deducted, so you add that back and you deduct from here. Okay, and then other comprehensive income, other components of equity, deduct 2.8. This would be added here. Okay, this is how it happens here. All right, so that's how we show separately, or if you want, you can show it single line also, whatever you feel is the best, and show it as a working out. If you've already done it for while explaining the exhibit 2, where answering the second question, second requirement, then you don't need to show it here. You can use the figures from there itself. Okay, right. Then comes the final. This is not necessary to you, but I am doing it just to show that it balances. This plus this. Let's see if it balances. This is the new non-current asset, right? Then a total current asset, total current, these are total non-current, 745.6. Then total current asset is, there's an adjustment there also where we have removed the subsidized current asset, because when we are consolidating, we would have added that. So now our total assets are non-current asset plus current asset, 2154, right? Share capital remains the same. There is an adjustment here, this plus this, this, let's see if it balances. Then there is an adjustment here. NCI is removed. Total equity is this plus this plus this plus this. It's total equity. Total liabilities. These are non-current liability. 40. We remove the current liabilities because we are eliminating subsidiary. We would have consolidated that. This is our total equity plus liabilities. There we go. It balances 2154.6 to 154.6. Okay. So this is how we make the adjustments. So be very careful with pluses and minuses when you are adjusting pre-populated spreadsheet. Okay. So this is how you answer this question. All right. So there is discussion plus there is calculation. Yeah. And with that, we conclude question 1. Then we have question 2, which focused on Apani Waco, the parent company, the financial year of 31st December. Exhibits about statement of cash flows describe the treatment of some transaction in consolidated statement of cash flows. So they're talking about statement of consolidated statement of cash flows. Important again. Then second exhibit about ethical issues describes ethical issues facing Mr. Lennox, one of the accountants of the Apaniva group. So I would like you all to attempt this question. All right. So we'll discuss this next week maybe, right? Or let's see if we'll discuss the pre-March mocks question 1, question 2 as time permits. All right. So using exhibit 1, discuss the correct presentation of following issues in consolidated statement of cash flows. Discuss the correct presentation. B, using exhibit 2, discuss the ethical issues and the actions which Mr. Lennox should take to address these. There are professional marks. So that's question 2. Okay. All right. That's question 2. So we'll take this question up maybe on next week. And we'll try to see how much of pre-mock that we can do. So all the very best with your SBR exams. Please attempt all the past papers. Just like the plan that we saw here, try to implement that, do as many past papers as possible. If you are able to do that, you definitely will be able to ace your exams. All right. So with that, I'll see you all on next week. Until then, stay safe, take care, have a great week ahead, have a great study session ahead, and all the very best with your SBR exams.